Welcome back. I'm Josh Morin with Infinite Financial Solutions, and this is the final video in our three-part video series on building a secure retirement income using annuities. By now, you understand the why, that retirement is about income, not assets, not the nest egg. It's about income. And you understand the how, the different types of annuities and how they work. Now it's time to pull everything together and show you how to actually fund and implement a retirement income plan that gives you control, flexibility, and peace of mind. We're going to talk about where the money comes from. Yes, the money that's going to be funding the annuities, where that's going to be coming from, how to navigate the different tax rules. And I just want to make a disclosure here. I'm not a CPA, so obviously anything that I'm sharing with you, and then if you were to work with me and or one of our agents, you want to ensure that you're speaking with a tax professional to ensure everything is kosher when it comes to the tax planning. How to layer income at different stages of retirement. It's called laddering, and I'm going to show you some of the advantages of being able to set up multiple different types of annuities for income starting at different ages, and what a fully structured retirement paycheck plan looks like in the real world. So let's build your blueprint. At Infant Financial, we use a clear two-tiered model to design retirement income. Tier one is paychecks. These are the bills and expenses that are essential, the bills that must be paid every single month, no matter what. Now, there's going to be some exceptions here, but housing, food, insurance, utilities, healthcare, etc. So we're going to fund these things with guaranteed income. So that means Social Security, pensions if you have one, so private pension plans if you had one. 97% of the good pensions from corporate America are no longer around, and lifetime income from annuities. Tier number two is going to be paychecks. That's everything else. So that's could be travel, gifts, hobbies, experiences, family, all the good fun stuff that you deserve to do when you're in your retirement years, in your golden years. And we want to fund these with flexible assets. So that's going to be your investment accounts, your brokerage portfolios, Roths or cash savings, real estate income. So if you have some form of real estate portfolio where you're receiving income every month from tenants, that's what's going to be included in your paychecks. Your goal should be to cover 100% of your paycheck tier with income that's guaranteed, and let the rest of your portfolio support your lifestyle. That's what creates financial peace. So you want to ensure that all of the paychecks that are going to be owed on a month-to-month basis, that those are taken care of for the rest of your life. So where does the money come from to fund the annuities? You actually have several options when it comes to funding, and each one has different tax treatment and strategic implications. Let's cover a few. Let's start with qualified funds. This is typically the most common because most people, especially in middle America and or have worked in the corporate entities, have formed some form of self-directed IRA, a 401k, 403b, something that's going to be an employer-sponsored contribution plan. So this is one of the most common sources. Now, these dollars are going to be pre-tax, and most of them are sold on a tax-deferred basis. So it's not Roth accounts. These are going to be all tax-deferred. So when you roll them into annuity, it's a non-taxable transfer, which is considered a direct rollover or 1035 exchange. So it's in a qualified account. When you roll that over into an annuity, there's no fees and no taxes associated with rolling that over. But every dollar that you pull out later is going to be taxed as ordinary income. So future planning, when it comes to your tax or provisional tax imprint, it's imperative that you actually take this in consideration because it is going to affect your income in your retirement years. These annuities are subject to RMDs, which are required minimum distributions starting at age 73, unless it's what is called a QLAC, QLAC. So it'd be a qualified longevity annuity contract, and I'll break that down here in a minute. Qualified funds work great for income riders, deferred income annuities, and longevity planning. So the first type of account that you're going to roll over, or where the funds are located for that rollover, is going to be qualified funds, and that's going to be from an employer-sponsored contribution plan, 401, 403b, etc. The second type is going to be non-qualified funds. So this is money that's in a savings account, brokerage, bank, CDs. So this is post-tax dollars. So this is money that's already been taxed. Now the gain is what's going to be taxable. So only the gain is going to be taxable, and it's taxed as ordinary income, not capital gains tax. So once again, if you work with a tax planner, a CPA or a tax planner, you can help eliminate or mitigate your provisional tax imprint later in life because you have to take in consideration Social Security income, pension, and other income later down the road. So many income annuities use the exclusion tax ratio, which allows a portion of the income to be treated as tax-free return of principal. So this creates a blended tax advantage that can reduce your taxable income during retirement, especially in the early years. So what does that mean? So that means is if you've funded the policy with post-tax dollars, when you go take out money, they essentially create what is called the exclusion tax ratio. So you're not taxed on all of it because some of that money's already been taxed, right? Now they can't essentially say if you have $100,000 and then it grew to $150,000, they can't say, oh, if you take a $10,000 withdrawal, 3,000 of it was principal and the rest was your gain. Essentially, what they're doing is they're doing a blended tax treatment to that, which is going to reduce your overall tax imprint later on, which is called the exclusion tax ratio. The third type of funding would be a Roth IRA or Roth conversion dollars. So this is one of the most powerful funding strategies for annuities, in my opinion, especially for high net worth retirees that are expecting higher tax rates later in life. So this is going to be future planners. Now, contributions are after-tax dollars. Now, and growth and withdrawals are 100% tax-free as long as the account maintains its qualified tax-free status. And you could use Roth funds to fund an annuity with an income rider and enjoy tax-free lifetime income down the road. And we often use partial Roth conversions over a series of years to fund these types of annuities while keeping taxes under control. So we'll do what is called a backdoor Roth conversion. So if you have a self-directed IRA or funds that are not been taxed yet, then we will do a conversion with the insurance company. And sometimes it's called a tax recapture. So they'll offer a fixed indexed annuity with a premium bonus to offset some of the tax exposure that you would have because over the 5-year period, you're going to pay taxes on that money. Now, as you transfer that money over with the premium bonus, it's going to offset some of that money lost to taxes. So it's called a qualified backdoor Roth conversion with a tax recapture utilizing a premium fixed index annuity or premium bonus fixed index annuity. Now, once you understand your funding source, which we just went over, the next step is timing your income streams, which is incredibly important. So here's where things get really powerful, is laddering your income across multiple annuities based on your projected needs at different ages. Now, this is not one size fits all. It's going to be tailored specifically to you, your needs, and how much income that you're going to need. So let's take a look at a few simple examples. Let's just say your age is 60 to 70 years old and you have Social Security lay, plus you are wanting early income. You might fund an indexed annuity with an income rider starting immediately or in a few years. This is going to cover your income during your bridge years, what you'd call, before you're taking Social Security and having that funds kick in. The next example would be someone age 70 to 80. So these are going to be your peak retirement years. Here's when we would layer in a deferred income annuity, a DIA, which would be purchased earlier. So you have to be forward thinking, and then you're turning it on during these years for income. That income is going to stack on top of your Social Security. So you're going to take the income annuity, you're going to receive those funds for income plus your Social Security and any other existing income streams. People aged 80 plus. So this is going to be longevity protection. So essentially what we could do is potentially fund another annuity with income starting at age 80 or 85, specifically designed to hedge against outliving all other assets. This could be a QLAC if using IRA funds, which defers RMDs and creates high efficiency income. Now there is some stipulations on QLAC funding, which is 200,000. I won't get to get into the weeds of that, but we don't do a ton of those, but it is something that does pop up. This approach creates a multi-stage retirement income ladder where every 5 to 10 years, another source of guaranteed income activates, giving you predictability, flexibility, whilst preserving your other assets. Let's address a few key points that impact long-term outcomes. Most importantly, tax bracket management. You want to mitigate your tax exposure, and of course, you want to meet with a CPA, but utilizing these powerful tools in conjunction with a well-versed CPA will be your greatest asset long-term and not throwing money down the drain. Now, if your income is too high in retirement, you're going to risk a number of things. Number one is going to be higher Medicare premiums. So you're going to have to worry about your Medicare premiums skyrocketing if you have too much income in retirement. Social Security taxation, elevated RMDs, then making you forcefully take out more requirement minimum distributions out of those funds and those qualified accounts. So by strategically funding annuities and in some cases converting those to Roths early, especially if you have enough time, we can keep your taxable income low, preserve benefits, and maximize control. Life insurance is a legacy tool. When we use annuities for income, we often pair them with permanent life insurance to handle legacy goals. So this means that you spend your money while you're alive, knowing that your family is protected. Your state passes on tax-free, and you don't have to live below your means just to leave something behind. Now, this is the perfect pairing. So you have annuities for income, so that's going to be your paychecks and playchecks, and your life insurance for wealth transfer. It's super important because you don't want to sit there and be like, I only have so much money to leave behind and I just want to be super frugal. No, you in your retirement, you want to enjoy it, right? You want to live your golden years healthy and you want to be able to spend that money that you've created. So spend the money that you've created on yourself, on your family, on your life experiences. And then life insurance can offset some of that spending. So if you had $1 million in life insurance or $500,000 in life insurance, you know that's going to be guaranteed to pass on to your beneficiaries instead of having to sit on your nest egg and try to squeeze out or be super frugal with your retirement money. Let's take a look next at liquidity and access. One common concern would be, what if I need access to my money? So here's how we can handle that. We only annuitize or lock up what's needed for guaranteed income. That's super important. That's going to be a very small portion. We keep a portion of assets liquid, of course, and the insurance companies, when you go through suitability, we have to go through a full liquid and non-liquid asset suitability checklist, and they will make sure that we're actually doing our job as a broker properly. So we keep a portion of assets liquid or even semi-liquid, often in indexed annuities with free withdrawal provisions or penalty-free zones. And we maintain emergency reserves outside the annuity structure. So you want to make sure that not all of your money's tied up into this. Like I said, when you go through suitability with the insurance company, they won't even allow you to tie up more than what they deemed safe and secure in liquid versus non-liquid assets. So you don't have to give up flexibility to gain security here. We do have options. You just need the right structure. Let's move into some real case examples from clients that we've helped in the past. This couple specifically is in their early 60s. They have $1.2 million between their IRAs and their non-qualified accounts. $3,000 a month in Social Security would be expected at age 67. They don't have any pension plans or any other income via their employer-sponsored contribution plans. Their goal ultimately is $7,000 a month total in retirement income. Here's a plan that we're going to provide to them. Number one, we're going to put $400,000 into an indexed annuity with income rider starting at age 65. $150,000 into a DIA, which is a deferred income annuity, turning that on at age 75. $50,000 a year in Roth conversions for 5 years to fund a tax-free income annuity starting at age 70, $150,000 kept liquid in brokerage accounts, and a life insurance plan purchased to restore legacy value. What's the result? The result is $7,000 a month guaranteed by age 67, tax efficiency income through the age 90 plus, zero market risk on guaranteed income dollars, Roth income and life insurance for flexibility and passing on tax-free money to their heirs and beneficiaries. Now that you understand how annuities work, how they're funded, and how they can be structured across different phases of retirement, the next step is applying this knowledge in a strategic and personalized way. No two retirement plans are exactly the same, but the process to build a foundation always follows the same core principles. Here's how to start putting these pieces together. First, start with defining the income gap. Determine what needs need to be covered every month to live comfortably and confidently, and compare that to your current guaranteed income sources like Social Security or pension. Next would be organize your assets by tax type. Take a clear inventory of where your money's at. Is it pre-tax dollars like IRAs or 401ks that you're going to get taxed on distributions? Or is it after tax like brokerage or savings? Or is it tax-free like Roth or cash value life insurance? Each type plays a different role in retirement income planning. Next on the list would be match the timeline to strategy. This is really important. So think about when the income is going to be needed. Is it now? Is it soon? Or is it later? And then you want to layer or ladder on solutions accordingly. So this can include indexed annuities with income riders, deferred income annuities, or other structures that align with your timeline. You want to maintain flexibility. Not all your dollars should go into guaranteed income annuities. It just doesn't make sense. You'll also want liquidity for unexpected needs and the ability to pivot as life changes. You don't want to be an all eggs in one basket approach to things, and we don't suggest that, and that is not our holistic planning process here at Infinite Financial. You want to use the right combination of tools. Obviously, if you have two of the same screwdrivers and you need a Phillips and a flathead, and it's just not going to work. So you're going to want to use the right combination of tools to get the job done. Annuities can handle guaranteed income, and other assets can provide growth or liquidity. The key is having each dollar doing a specific job in your retirement plan. At the end of the day, retirement income planning is about clarity and confidence. Whether you're planning your own retirement or helping others plan theirs, this education gives you the framework to build income that lasts, that withstands market uncertainty, and removes the fear of running out of money. If you're ready to take the next step, apply what you've learned, map out the income needs, review the assets available, and begin structuring your own retirement income blueprint. This concludes our three-part series on annuities and retirement income planning. I'm Josh Morin with Infinite Financial Solutions. Thank you for watching, and remember, a secure retirement doesn't happen by accident, it happens by design.